Assalamu alaikum, masal khair. Hello, everybody, and welcome to day 2 of Abu Dhabi Finance Week. It's a great pleasure and honor to be back here in this beautiful capital of the United Arab Emirates. And welcome to you, gentlemen, flying in from New York, Paris, and London. First of all, to kick off this panel, I want to ask you, you all have long careers in deal making, but is there one single deal that stands out and made your career? Let me start with you, Donald.
Well, I don't know if it made my career, but a transaction that stands out is probably something more recent. It was a deal we did in 2017, and it was a deal that was quite complex. It was the acquisition of Novo Banco in Portugal. This is the bank that was the result of Banco Espírito Santo's being taken over by the Portuguese state. I think there was a lot of concern by others in terms of the complexity of execution, how to value the assets on the balance sheet, how to deal with the stakeholders. You have the Central Bank of Portugal, the ECB, as well as the European Commission. We invested €1 billion in the bank. It had 90% cost-income ratio at the time. We ended up having to reduce the NPL ratio by 90%. And we successfully turned the bank into profitability and executed a sale agreement with French bank BBCE earlier this year. So we acquired it for €1 billion. We sold it for €6.4 billion. But I think the other thing that kind of makes us quite happy is that the sale process was one where we really took into consideration all the factors that were of importance to the workers, the employees, the management in the state. So I think it was a good result for Portugal and certainly a good result for our investors.
Bob, what was the number one deal of your career so far?
I think number one is clearly the acquisition of the U.S. Lehman Brothers business during the financial crisis in 2008. It was truly a bulge bracket bank, truly a world leader in equities and mergers and acquisitions and mortgages. It was a business that we actually tried to buy the entire thing over that weekend. And the weekend was probably tougher on the whole world, as it turned out, and nothing happened. And they declared bankruptcy that night. But we had the fortitude and the support of our board, which at that time was really, really important because the world was kind of falling apart on that Monday after Lehman weekend. And we were able to acquire the U.S. business out of bankruptcy by the end of that week. Excuse me. I won't repeat the whole thing, but it was the opportunity to acquire the Lehman Brothers bulge bracket U.S. business over that weekend. In the following year, 2009, a business which we paid $1.5 billion for, the building was worth $2 billion. We made $9 billion in the first year. So it was, and I would say the other thing, to be perfectly frank, the reward was also the saving of 10,000 jobs.
Yeah, absolutely. The human component is so important, and you mentioned the culture there as well. Over to you, Thomas. What was the most exciting deal of your lifetime so far?
So thank you. So it's actually a series of deals. My point here is that in long-term investing, at least on the equity side, in order to do the best deals, you need to make sure that you are part of a secular trend and that you catch this trend pretty early in the cycle. So I'm talking here about energy transition. We started investing 10 years ago in that field. It was not very well known. We launched the first ever private equity fund dedicated to energy transition on the back of two very strong convictions. One was that with regards to the solution providers to the energy transition, financial return and impact were actually two sides of the same coin. And the second conviction was that the world was actually switching from a place where value creation was driven by efficiency on the back of 40 years of downtrend in interest rates and globalization that has allowed companies to over-optimize a lot of things from capital structure to supply chain, to a world where growth would be driven by value creation, would be driven by resilience. And in that context, probably that growth would have to slow down because we will be living in a world which would be less optimized. And in that world of low growth, the pockets of high growth would be concentrated on the solution providers to the resilience. And so we read the IPCC report, figured out that in order to achieve the energy transition and the Paris Agreement, the target sets at in Paris at COP21, we collectively needed to deploy $6 trillion of capital every year in energy transition, of which 80% had to be concentrated on transforming the existing system. So meaning that you could invest in, venture capital technology that would, maybe save us in 15 years for 20% of the investments, but 80% had to be driven by transforming basically industry, agriculture, transportation, and buildings. And so we started investing in those companies, low-tech companies, boring businesses that in the end, caught up this very long-term secular trend. Those companies started to develop in Europe because, actually regulation was tougher there. And now they are developing everywhere in the world. It's probably the best investment we've made so far.
Congratulations, Mabruk, to all of you, and we can learn a lot from all your experiences. I think you should all be professors of finance at some point, or write a book at least. Bob, you have closed some of the biggest financial transactions in the world. What is a measurement of success? What are the key factors how you basically, after a deal closes, you are like, well, this is a good deal? What makes you think that?
I touched on it a little bit. There's always a nice feeling, as I said, when the result of a good transaction was saving 10,000 jobs. And I remember as we were negotiating for that, Mayor Bloomberg of New York City at the time came to the office, kind of grabbed me by the lapels and said, "Bob, you do realize the impact of this on New York City." None of that takes away from the fact that all of us are in the business where, we need to have the right valuation, and we need to have the right alignment with management, and ultimately the right rewards for the investors and for the shareholders. But I think, to your question, it's a great feeling when we're able to do all of those things and create something strategic, something that's going to be ongoing, and something that can create economic value and job creation. But from the very, very beginning, I have found that if I focus, or if we as a team focus on the valuation when we enter an investment and the alignment of management with the investors, we generally come out with a pretty good outcome.
Mm-hmm. Now, in this anatomy of deal making, how is AI, and that is a question to all of you, and new technologies and machine learning, how is it disrupting or supporting traditional deal making? Donald?
Okay. Well, look, we're certainly analyzing how AI can be helpful to our businesses. The space that we're in is much more industrials, manufacturing. It's an old world economy. So not directly related by AI, but certainly a space that is going to benefit from utilizing these tools. And I think one of the things we look at is the disruptive force that AI could have to the model of the company, whether it's calling centers or some sort of service business. But what's more relevant is, we've worked to set up a center of excellence in AI within our underwriting team, to look at opportunities of value creation. How can we improve supply chains, procurement, pricing? We have companies that have 300,000 or 400,000 SKU items in inventory that need to be matched with buyers. And so we have RFPs coming in. How can we utilize AI tools to try to optimize meeting that customer demand. And so I think one of the things we do is we look at that as a very specific space within our due diligence process, the opportunities that we have, and certainly analyzing the risks that it can present. But it's a necessary part of every transaction that we look at.
Do you agree with that, Thomas?
Yeah, so there are several angles to the question. First, I mean, in terms of investment company, we are using AI mostly to improve, client servicing, reporting, to screen deals. So the first layer of deal screening is, benefits a lot from the inputs of AI. Also for what we call connect the dots. So who knows whom in boards and networks, etc. We are using AI for that, but something which is very important for me is to keep AI away from making any kind of investment decision. So I think that's, at least it's a very strong conviction that investment decision needs to remain a human decision. Also, not only because of the, potential danger it represents, but also because we like to be contrarian, and I think that you cannot necessarily be contrarian if you are using too much of AI to take your decisions. So then, of course, assessing AI impact on our portfolio companies and how AI can help or threaten your portfolio companies is paramount. And then there is the last but not least, I would say, the opportunity in itself to invest in AI. And there, as we are a bit contrarian, we are a bit reluctant about putting money where everybody goes currently. So the play we've taken to navigate this AI ecosystem is to finance data centers. So we think that instead of being an owner, there is a sweet spot for data centers that have secured their power, secured their building permit, but not found their final client. So you take construction risk and commercialization risk, and that you can finance at double-digit returns, which are kind of equity-like returns. So we like to do that, and also as I told you, we like to finance the sellers of picks and shovels, and so the play on energy transition is also a play on AI, because again, reading the IPCC report, in order to achieve energy transition, you need to electrify the end user. To electrify the end user, you need an efficiency of the grid. And the companies that are helping this efficiency of the grid, being companies involved in the maintenance of power cables or developing software to optimize solar farms, are also a play on AI.
Yeah. When it comes to, yes, Bob, go ahead.
One of the areas that we're working on at Atlas Merchant Capital is the consolidation of regional and community banks in the U.S. And most people, even Americans, don't realize this, but there are 4,500 banks in the United States. And ever since the steep rate increase and the failure of SVB, we're seeing regional and community banks combining. So using AI as an example, there's really two ways it's helpful. One is the enormous amount of work that our staff does in looking at the 4,500 banks and where the opportunities are to be an acquirer or to be acquired. AI has been an incredible help in speeding that process up much more quickly with much less stress on our team. And then secondly, and amazingly, is we have identified the potential winners and complete transactions in merging is the value of AI to these smaller institutions, and their ability to compete with JP Morgan and B of A is phenomenal. So it's really on the front end of helping us, work through the universe of opportunities and narrow them down and analyze them. But also in banking, the impact of AI in the efficiency of the smaller as they compete with the larger is really incredible.
Yeah. When it comes to downside planning, Don, how does your team approach that, and what kind of advice do you offer?
Okay. Well, look, I think any of these transactions, we're sector agnostic, we're non-thematic. So we're looking at each individual transaction as a standalone. We're doing our best to dive into those situations. the norm is not to have perfect information. So we're always doing what we can to analyze on a line-by-line basis. I mean, an extension of the previous conversation, one of the uses for AI, AI is a tool. It's not an end, it's the means. We use AI to help try to access and crunch a significant amount of data as best as possible. But, the single biggest thing we want in those situations where we have less than perfect information is to make sure that which you don't know doesn't kill you, right? So we try to assess the gap, and within that, we try to structure as best we can around it. And at the end of the day, if you feel like there's a key element of information missing to help you to determine the ongoing viability or the business prospects for this company, we walk away.
Yeah. At TKO, Thomas, you really emphasize patient capital and differentiated sourcing as well. When the whole market goes against the flow, but you're still convinced on a successful transaction that this deal is actually going to be successful. What makes you keep going on that track? Why are you convinced and can't stay away from it?
Well, I think you need to, in this new environment, you need to have very strong convictions. I mean, the easy days, I would say, of private asset investing are over. I'm sorry to tell. There will be much more dispersion than before. If I schematize, and of course I'm exaggerating, but buying an asset-light business, putting a lot of leverage in front of this asset-light business, and waiting for interest rates to go down to refinance your debt and benefit from multiple expansion is not something that will create a lot of value in the coming decades. So you need to have strong convictions. I think that the way to invest in private equity will change a little bit. If you look at companies in the world, they will be less optimized. The fact that that they need to be more resilient, they need to produce closer to the consumer. It's more costly. The cost of insurance is increasing. Cyber insurance, climate insurance, corporate insurance. They need to operate with higher capital buffers, less debt to cope with crises like the COVID crisis. They need to operate with more inventories. So I think efficiency is less of a paramount. For that, companies need to slow their growth. Earnings growth is going to slow. They need to be more resilient, and they need to be more asset heavy. Even in tech, look at Microsoft; they are more asset heavy than before. And so I would say that my point is Warren Buffett investing is probably the new way of investing in private equity. And so I think we're going to look more at the way the cash flow is allocated, the way the asset allocation is made, because building the right plant at the right place at the right time is not easy. It will create a lot of dispersion. Looking at return on invested or on capital employed and invested capital will be more important than before. And if you look at what we've been doing at TKO for the last 15 to 20 years, we've invested in sectors where companies are more asset heavy. We have used less leverage than the average of the industry, 3 times EBITDA on average for our current portfolio. And we are pretty comfortable with that way of investing going forward.
Bob, if you have to give us a little masterclass on how to structure a deal, because the interest rates, they keep moving, the regulatory environment keeps changing, but what are the key ingredients? How do you structure a deal, the basics?
Well, I think right now in financial services specifically, do you hear that okay, I think? Yeah. In financial services specifically, we've seen a change of administration in the US that is much more positive on consolidation, much more encouraging of the consolidation of regional and community banks, much more proactive in innovation, allowing the IPO of Circle, for example, and stable coins and in digital versions of the dollar. So we have some real tailwinds right now, and I think that's that's very important. I think what is counterintuitive to people is that generally higher interest rates are beneficial to financial services. And the lower the interest rates go and the flatter the yield curve, the more challenging it is. And so over the last couple of years, since the rates have gone back up, having rates at this level, where the expectation is a decline in a positive yield curve, is the best environment in the world. So when we look at investing in financial services right now, there's a clear tailwind from the US administration in terms of being proactive in an integrated, simple, straightforward regulation. And I think that's spilling over into the other place we like to invest, the UK and Europe, where they're becoming more competitive in financial services.
Yeah. Donald, when, a deal looks super attractive, like the terms and the sheet and like the whole macro environment is super perfect, what still makes you move away? Is it like the gut feeling, still intuition or something, or a personal connection? What could make you walk
away? Why not to do a deal?
Yeah.
Look, I think there's always a lot of reasons that you can find as an excuse not to move forward. I mean, I think for me, one is probably more because of the investment style we have, which is, as I mentioned, we're non-thematic. We're investing in situations where we're trying to affect a step change in the company in the first 2 years. That really means assessing the optionality, the levers that we can pull in the transaction to create value. And I think at the end of the day, if the situation is one where, our return is really going to be driven by simply, multiple expansion or top line revenue growth, where there isn't a lot of alpha to add, it's probably not a deal that is interesting for us. But I think if there's one singular thing for me, that's a deal killer is what I call a transaction that has low probability, high severity risk. So quite simply, the risk of an event maybe have low probability, but it's existential. And it can be a situation where you have a company with a predominantly one major customer, and maybe its switching costs are not that high, where contract terms allow it to terminate a significant part of the economic agreement in place, or it could be one where there's a significant regulatory overhang or the risk that a change in policy or change in regulations turn the business model upside down. So, and I think those situations exist, but it's assessing that and taking a decision affirmatively that it's not a risk that you're willing to take. That's something that's an obvious deal killer for us. And it can be hard because the deal can look really attractive on a relative value basis with a good management team. Yeah. But at the end of the day, we want to take any risk to the capital.
Before we go, I have a final question to all of you. I need to finish on time because I'm Swiss. So I want to ask you, what does the deal of the future look like in terms of structure, but also geographies and maybe industry as well? Thomas, any bet?
So I think, with deglobalization and the building of resilience and sovereignty everywhere, you need to be local.
Yeah.
So as a principle, we do not invest in countries where we don't have an office. At the opposite, it's very rare that we do only fundraising in one part of the world, because we think that fundraising goes with local investing, and both are, serving each other. And so you need to be very local. You need to have very strong convictions, and of course, the Middle East and Asia Pacific region is, of course, extremely exciting. When you look at the stats, there are many of them, but just one is when you take Hong Kong, you draw a cycle of 5 hours flight around Hong Kong. That's an economist called Charles Gave saying that in this cycle you've got more people than outside, so on Earth. You've got 69 of the top 100 cities in the world inside this cycle. And when you look at the way those cities have developed, they've developed very independently one from another, because there was no infrastructure. For example, there is no direct flight between New Delhi and Beijing, right? The two most populous countries in the world. So the fact that, there is a lot of infrastructure spending going on in this region, from high-speed train to airports to, power lines, ports, etc., roads, will probably create a lot of value in this region. And of course, listening to what sovereign wealth funds from GCC are saying, they are massively pivoting large amounts of capital towards this region. So Asia is very exciting.
Bob?
There are two things going there. We think of ourselves as experts focused on financial services. We spend all of our time on financial services, and there are two phenomenal things going on right now. One is, of the 4,500 banks in the strongest economy in the world, with the best financial services industry in the world in the US, there is a need for consolidation, and it is just throwing out values. The smaller banks who provide so much, 50% of the lending to small businesses comes from the regional and community banks. And yet the smallest are safe, but just too small to succeed with the costs of technology and the cost of regulation. Consolidation will make the whole sector stronger, better competitors to the big banks, and better servicing of small and medium enterprise businesses. And it's all about cost synergies. It's too good to be true. The second thing we see, and we really learned this when we began investing in Circle, the US digital coin, USDC, in 2021 and 2022. What's happening in the blockchain is really profound. And we believe that the benefits of that technology over the next 3 or 4 or 5 years, we're going to see blockchain emerge as the underlying technology of financial services writ large, not just in the US, but frankly, here in the Middle East, more of the banks in Abu Dhabi, in Dubai, in Iraq, in Qatar, in the Kingdom are already using blockchain in some of their businesses.
Mm-hmm. Yeah. What a different landscape than when you came here 30 years ago, right? Yeah. For the first time.
Very different.
Bob has been here many decades ago for the first time. What about you? Final words, Donald?
Sure. And look, the risk of answering this question last is that some of it's already been repeated. But, look, I think we are the global aspect of our economies and the business flows. We're inextricably linked with each other, and I think that's going to continue. I think the financial literacy continues to rise globally, which gives rise to transactions in areas where maybe historically we wouldn't have invested. I mean, I think for us, rule of law is incredibly important. Stable financial systems are important. But when you look at, for example, places like here in the UAE and Abu Dhabi in particular, you have a high level of financial professionalism and an interest in working together in partnerships. And I think, capital as partners as opposed to just an investor is something that continues to ramp up significantly. You can see that in the quality of the people attending here today and the interest in a format like this. And I think, for us, we have, looked at the region in a very different light over the last several years in terms of the operating businesses we've moved into the region and what we're trying to accomplish in partnership with existing family businesses here and families who are interested in expanding beyond the borders of the region and outside of the GCC. And I think that's very exciting. And I think it's good for us to continue focusing on the dialogue that helps that to happen.
Do you think that the next big deal will come from this region?
Well, I certainly think, I'm hoping that the next time you ask me the most profitable deal we've done, I say it comes from the region. So.
In exactly 1 year time here at Abu Dhabi Finance Week, we will know more. Thank you so much, Donald, Bob, and Thomas, for your insights. Shukran Gasilan. Thank you.